The broad thought process of portfolio construction for the Aditya Birla Sun Life Flexicap fund is that it needs to have three sleeves. The first sleeve is a benchmark aware strategy, which is primarily a risk mitigant from a thought process that some of our larger holdings in the benchmark need to have some representation in the fund. The second sleeve is basically the best of breed investing framework, which is primarily focused on counter-cyclical investments, which is to back companies which are going through tough periods from a sectoral point of view, but which within a particular sector are sharply increasing their market share and mind share and are coming up with newer products and are coming up with newer offerings which bring down their overall cost structure or are trying to improve their return on capital employed. This accounts for the foundation of the fund, which typically tends to have a low churn because we tend to give them a reasonable amount of time for them to perform. Between the first two sleeves, it typically accounts for anywhere between say 60 to 80% of the Aditya Birla Sun Life Flexicap fund. The last sleeve is basically the relative sleeve, which is primarily focused on relative returns. Here the thought process is to take a top-down approach, to take calls on which sectors are likely to do well, which sectors are likely to underperform. Should we be increasing risk in the portfolio or decreasing risk? Should we be going down the curve, etc.? Or should we be participating in a few IPOs or a few tactical opportunities? Which are the sectors and what are the key changes that we have done over the course of the last 7 odd months? We've reduced our exposure significantly from financials. That used to be a very large exposure before. We've reduced it significantly. Within financials also, we've increased our exposure to insurance sector, which has gone through a reasonably tough period over the course of the last 3-4 years, and where we have persisted with some best of breed investing companies which have gained sharply market share and mind share. We've increased our exposure to IT within this fund over the course of the last 7-8 months. We've increased exposure to auto, and more importantly to auto ancillaries, where we see a tremendous amount of opportunity which is coming from the China Plus One strategy as well as the greater exports that we are seeing as the world suddenly realizes that EV is not the final solution which can happen very quickly. And therefore, there are a lot of ICE components, which is the internal combustion engine components, which they will continue to keep requiring for a reasonable amount of time. And Indian companies are very well endowed with large capacities in that front. We have increased our exposure to capital goods and engineering, and we have increased exposure to real estate. We have also increased our exposure to pharmaceuticals and healthcare over the course of the last 7-8 months. So from a sectoral point of view, we think that there are 3 or 4 large sectors which can be potential dark horses. Sectors, for example, include the consumer durables, where we have a large overweight across a whole range of brown and white goods. That could be a very interesting opportunity wherein over the course of the last 4-5 years, this has been a space that has struggled, and where we believe that we are closer to the end of this cycle of weight. Similarly, we have large weights in pharmaceuticals, which has again been a space which peaked in 2016 compared to the markets and has been a reasonable lackluster performance since then. We have a large overweight over there as well. Metals is another area where we have an overweight stance on, where we think that the balance sheets have got repaired significantly and there is significant under ownership. IT is another area where which is not currently the flavor, but we think that there is a marked improvement in offshoring that can happen. Of course, everybody is worried about the recession that is likely to happen over the course of the next 6-12 months in the Western world, but we think that this is possibly the most well-advertised recession in the making, and post that there is going to be a flush of orders coming into the Indian IT system. We continue to remain positive on auto and capital goods, where we have increased our weights compared to where it was in the past, and we would like to further increase our weights into this sector as and when we get attractive opportunities from a valuation standpoint of view. As far as financials is concerned, we think that we want to be market weight to slightly underweight in terms of financials. But even within that, we think that there are franchises like in the insurance space, like the large private sector banks, where we think that there is a lot more comfort in terms of their ability to create wealth over the medium term. We are large cap biased at this point of time. Close to about 77% of our overall fund is in large cap.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.